Hello and welcome to this session on derivatives. In this session, you will learn about some common terminologies associated with derivatives. This is by no means an exhaustive list. In fact, each type of derivatives comes with its own set of key terms. We will cover these terms separately in subsequent topics. In this session, you will learn about leverage, notional value, spot price, contract lot, exercise or strike price, settlement date, expiry date and rollover. In general, leverage, also known as gearing, can be defined as borrowing funds to make investments. In context of derivatives trading, investors can control large position in derivatives for little amount of outlay or even nothing at all. A company doesn't have enough capital to play financial markets can simply move between markets. In other words, it may shift its bets from financial markets, the bond market, the stock market, etc. into the derivatives market, namely futures market, the option markets, and to a less extent the swap market. Capital needed for taking positions in derivatives instrument is generally much less than capital needed to actually take position in bond or stock market. In some aspects, derivatives trading is similar to buying stock on margin. Notional value is a term used in derivatives, options and currency exchanges. It refers to the total value of the assets in a leveraged position. For future contract, it is contract size multiplied by the current spot price per unit. The contract size is the number of units a typical futures market contract controls. For instance, a future contract for crude oil controls 1000 barrels of crude oil. Therefore, if the spot price of a barrel of crude is $80, then the notional value of an oil's future contract is $80,000. A derivative's notional value is directly related to the spot price of the security. To calculate the notional value of a derivative security, the spot price must be known. The spot price is current market price of the security and the notional value is the total value of security's underlying asset. The notional value is commonly used to calculate the value of contract for options, futures, forwards, and forward exchange markets. The notional value is the value of a derivative security's underlying asset at the spot price. The spot price is the current market price of a security that buyers and sellers agree upon at a particular time and place. The spot price is important in derivatives market because it is the price at which buyers and sellers agree on the value of an underlying asset. Next we have contract lot, which is a term associated with options. In terms of options, a lot represents the number of contracts contained in one derivative security. The concept of lot allows the financial markets to standardize price codes. For example, equity options are priced such that each contract or a lot represents exercise rights for 100 underlying shares of common stock. With such a standardization, investors always know exactly how many units they are buying with each contract and can easily access what price per unit they are paying. Without such standardization, valuing and trading options would be needlessly cumbersome and time-consuming. Strike price. The strike price is defined as the price at which the holder of an option can buy in case of a call option or sell in the case of a put option the underlying security when the option is exercised. Hence, its strike price is also known as exercise price. For example, an investor purchased a call option contract on shares of ABC company at $5 strike price. Over the life of option contract, the holder has the right to exercise the option and purchase 100 shares of ABC for $500. If the price of ABC shares rises to $10, the options holder can lock in a $500 profit by exercising the option because it allows him to buy shares at $5 and sell them for $10 in open market. The strike price is one of the most important elements of options pricing. At expiration date, the difference between stock market price and option strike price represents the amount of profit gained by exercising option. Unlike equity instruments like shares, firms settle derivative contracts at the date specified in the instrument, the future date is called the delivery date or final settlement date. Both parties of a future contract must exercise contract, that is buy or sell, on settlement date. Expiry date is the last date that an options or future contract is valid. When an investor buys an option, the contract gives them the right but not an obligation to buy or sell an asset at a predetermined price called a strike price within a given period, which is on or before the expiration date. If the investor chooses not to exercise that right, the option expires and becomes worthless, and the investor loses money paid to buy the option. The expiration date for all listed stock options in the United States is normally the third Friday of contract's month, which is the month when the contract expires. However, when that Friday falls on holiday, the expiration date is on the Thursday immediately before the third Friday. Once options or future contract passes the expiration date, the contract is invalid. Rollover is a process in which investors carry forward their positions in a derivatives contract from one expiry date to another. Traders can either let a position expire or carry forward their bets, that is, enter into a similar contract expiring at a future date. In India, equity derivatives expire on the last Thursday of each month, so rollovers can happen till the close of trading hours on that day. Most rollovers begin a week before expiry and end till the last minute. Usually, contracts are rolled over to the next month. With this, we reach the end of this module. In the next module, we will cover over-the-counter or OTC derivatives in greater detail. I look forward to seeing you again soon. Thank you and goodbye.